Good evening and welcome to a live studio discussion for Financial Information Month under the theme 60 is the New 40. This month, we, the FIM Partners, celebrate Financial Information Month under the theme Financial Advancement through Enlightenment, Partnership, and Balance. I am your host, Luana Laura, CEO and founder of Finance Focus. We are a financial education and business support firm. And this evening, I am joined by three industry experts. We have with us Attorney at Law, Mrs. Noelis Knight Didier, who is the owner and founder of Caribbean Wills. Caribbean Wills is an online platform where you can create your own will, and she has over 19 years experience in the legal field. We are also joined by Mr. Brenton Hilaire, who is the agency manager for Sagicor Life EC, and he is also the president of the Dominica Association of Industry and Commerce. He has over 10 years experience in the insurance industry. And finally, with us, we have Mr. Augustus Ettienne, who is representing the Dominica Social Security. And he has over 35 years of experience as an integral employee at the Dominica Social Security. Good evening, partners, and welcome to our live studio discussion this evening.
Thank you.
It's really a pleasure to have you all here with us. Good evening to our listeners on all social media and radio stations, as well as YouTube and the Finance Focus page. We are excited to have this discussion this evening, and our topics will center around will creation, retirement planning, and building generational wealth. And I, for one, am excited because I want to know some more information on how to build generational wealth, how to plan for retirement, and of course, estate planning, which is very important, especially now within this economy. So we have with us our partners, and we are going to discuss some pertinent issues. When I launched this theme for this program, 60 is the new 40, I got a lot of feedback suggesting that it should be the other way around, that 40 is the new 60, given the fact that recently we have a lot of deaths among reasonably young people. Partners, panelists, how do you feel about that? Do you believe that 40 is the new 60? And for those who are 60 and over, what can they do to plan for this inevitable time when they leave this earth? I'll start with Attorney at Law.
Well, I would say, first of all, don't start at 60. Definitely not.
Right.
Well, I don't think that 60 is the new 40, but I get what people are saying. COVID has taught us a lot. Let's start with COVID. After COVID, after the pandemic of COVID, we saw how people as young as even in their 20s were losing their lives. I mean, can you believe that? You're 20 years old, you think you have your whole life ahead of you, and this unexpected pandemic hits, and that's it, you're gone, unexpectedly. I mean, it's not something we like to think about death and so on, but you know, it can happen. COVID has come, what's next? We have no idea. The same way COVID took us by surprise, anything else could come along and take us by surprise, and you know, it teaches us that we always need to be prepared for everything, no matter how young you are. I would say once you're an adult, you start thinking about your life, about your future, about building wealth, about how you can protect that wealth and protect that legacy even as you have children and into the next generation.
Yes, indeed. Brenton, how do you feel about that? 60 is the new 40.
60 is the new 40. I can see it applying to myself. The reason I say that is, personally, I'm a workaholic. So at 60, I don't see myself slowing down at all. I might be speeding up at that time. And I speak about myself, but when you look at society in general right now, you would find that a lot of people after retirement start taking up, what's the word that they use? Consultation jobs. So instead of just retiring and enjoying life, they're looking for ways to stay active. And it's not just active in working with a company, but then they're still giving back to society, going around mentoring. So it's like you haven't really slowed down yet. And when we look at those popular millionaires and billionaires in the United States, they're living the life of teenagers after retirement. So I think slowly the mindset is switching to one that we do not necessarily have to slow down as we reach those ages. So we have to find ways to stay active. If we want that lifestyle, if we want longevity, we have to stay physically active and mentally active too. I was once told that in retirement, you die when you stop. If you're accustomed to working all your life and you just decide to stop, you're really going to find yourself decline. So you have to find ways to stay active. Now, in terms of the reverse, 40 is the new 60. I disagree to that with what I just said. However, I'm going to piggyback on what was just said. We have to start preparing earlier. Back in the day, I believe society on a whole took financial planning for granted. That they would go through life, and towards the retirement stages, they started thinking about wills, started thinking about protecting their family and whatnot. But life has taught us now that life can happen at any point in time. In the insurance industry, we get to see everything that happens most of the time. And I speak to persons, I hear stories, clients that I speak to share stories with me. But right now, we have had situations where people as young as 23 are having strokes. I recently heard about a 25-year-old who had breast cancer. And it's not just one person, but if you have to dig deeper, it's happening a lot. And back in the day, in my time in going through school, that is the last thing that you would have thought of, that I needed to think about life like that. Life has changed, and it taught us that we need to start planning from the time we get out of college or high school. If we transition into working from high school, start thinking about what measures can I put in place to plan for the future, so that when you start planning early, by the time you reach 60, you can still act like a teenager. So it's a combination of both factors.
All right. A popular phrase these days surrounds generational wealth. What does it mean to build generational wealth, and how can we here in Dominica build generational wealth? What's the easiest way to do that? Brenton.
You know my answer on that already. And most people who know me know what I will say. The easiest way to build generational wealth is through insurance. Simple as that. Every other thing that we try to do to build generational wealth is dependent on time. If you decide you're going to go into real estate, you need time to build up the properties, to find the tenants, to make sure that the place is always filled. If you're thinking about investments, you need time for the dividends to flow in. If you're thinking about winning the lottery, that might take your entire life. But with insurance, you are guaranteeing that the process is going to start regardless of what happens to you. And it is to the point where if you take a policy today and you die tomorrow, your family gets the full amount of money. That's money that you may not have had access to, or you may not even ever have access to for your lifetime. So it is one of the most easy ways to start it. And I think the core concept that we have to understand is that it is not always about us. Someone once told me that when you plant a seed, you don't benefit from the shade of the tree. You're really putting the seed there for the generation after you to benefit from your hard work. When you think about generational wealth, we may not get to see our family experiencing what we have laid down for them, but we know for a fact that even after we are gone, somebody else will carry on that mission. And it does not necessarily have to be the next generation, because it really happens when you have that sort of activity transitioning between the different timelines. So I leave something for my daughter, she gets older, I'm gone, she has her own child, she builds upon it, leaves it for my granddaughter, hoping it's a granddaughter, and it keeps building up like that. So insurance is one of the easiest ways to do that.
Thank you for that. Mrs. Didier, many believe that leaving behind property is one of the best ways to build wealth. What do you think about that?
I would say that is part of it. Yes, investing in property, taking out a mortgage even, and building your property, and that goes hand in hand with insurance, by the way. You take out a mortgage, you make sure you have life insurance, so that upon your death, that mortgage is paid off. And the person you've left the property to doesn't have to think about pay in the bank for that property that you've left for them. So yes, having the property is one thing, but the other part of the equation is leaving that property in the right hands. You know, not just thinking, well, they'll take care of it, they'll do whoever they are. It doesn't matter. No, no, no. You to protect that property that you have worked so hard for and invested in, do a will. Definitely, no two ways about it. You prepare a will and make sure you name an executor who you can trust, who is going to make sure that that property goes to who you left it for. You may have 6 children, and you know half of them worth nothing. You know half of them, if they get that property, they're going to just, you know, squander it. You know, but you know so-and-so, this other child of mine, that person is, so you might leave maybe some cash for the persons who have squandered it, but your property, you know, you want it to stay and be developed, you leave it for this other child. May not be a child at all. Whoever you want, whoever you believe is going to do the best with this property, and it will do and the property itself will do well for that person. By your will, you can do that. By leaving a will, you can name those persons that you want your property to go to. And that way, yes, you build generational wealth, certainly.
So I'm happy that you preempted my discussion when it comes to will creation. You vaguely expressed the importance of a will, but I'm shy of 35. So why should I prepare a will? Why should my parents prepare a will?
Well, there are many reasons. I think it will take us beyond the hour. Let's start with obviously, you are shy of 35, you may or may not have property. Let's say you don't have any real estate, because I think many people think that way. Well, I don't have any real estate, any house. I don't have a house, I don't have a home. Why should I do a will? Guess what? You might have a car. You might have money in the bank. You might have a family heirloom, your earrings, something that somebody has left to you that is special to you, that you in turn want to leave to someone else. If you don't have a will, that's just going to sit there. Who knows who will get it? Who knows who will get it? So you leave a will for those things that are special to you, that you want to leave to someone as well, even though you don't have a home. Obviously, if you have a home, you ought to leave a will to ensure that that home goes to the people who you want it to go to. If you do not have a will, what happens is that your property goes into intestacy. Intestacy simply means that the law says who gets your property. And the law has all kinds of rules. I can tell you the wife is last, and the husband or the wife, the spouse is last on that list of people that get your property. So it is, you know, they get like a life interest in a half share of your home. What is that? You know? So that's the best way to do it. You know, you leave it for the people who you want to. That's the importance of having a will. Another reason is through a will, you can actually name a guardian for your child. If, for instance, you are a single mother or a single father, you and I will use a lady. You're a single mother, the child's father, you know, has played absolutely no part in the child's life, has practically abandoned the child. You are a single mother. What happens to that child after you pass away? In your will, you can actually name a guardian to take care of that child if they are still a minor while after you've passed, obviously.
I want us to circle back to the will creation and estate planning conversation shortly. But Mr. Ettienne, I recently conducted a close survey of a target between 18 and 35 to understand if they knew the importance of Social Security and the role that it plays, the importance that it plays. And the general consensus was that they believe that Social Security is a scheme that by the time they reach the age to benefit from it, they may not even gain the full benefit. What words can you share with us and our listeners to change that perspective when it comes to Dominica Social Security and the benefits?
I want to piggyback on one of the points that you raised in the feedback that you received from those young persons, that by the time they get there, they will not sure they will receive the full value of the benefit. What is the full value of the benefit? That's a big question, because the system exists to provide income protection to contributors, or we call them insured persons, and their dependents. And those benefits accrue to them, or they are able to access those benefits upon the occurrence of specific events, some of which occur early in their lives while they are young and working. For example, if you're at work and you fall sick and you cannot work to earn your salary for a period of time, the system will replace up to 60% of your income. As a young woman, if you become pregnant, you will have to abstain from work for a while to have your child spend some time nursing and bonding with that child. And for the period of time that you stay away from work for that reason, you will not be able to access your salary. The system pays you up to 60% of your earnings during that period of time. But for the bulk of the contributions that we make, it is for the long-term future. When we become pensionable, and we are supposed to get that pension from the time we become pensionable for the remainder of our lives, however long that is. And in that situation, the only thing that determines what is the full value of a benefit is once you qualify upon becoming pensionable, you are to be paid until you die. And it is your death that will determine how much your full benefit will have to be. And it doesn't even end there, because if you die leaving dependents behind, the benefit continues to go towards your dependents. So what is the full value of your benefit? What you have to recognize is that once you participate in the system, you make your contributions when you are required to, you have access to a range of benefits that can go from the cradle to the grave, really.
What are some of that?
We create from the cradle to the grave, because when you have a child, you receive 60% of your income for the period you stay away from work for having the child. And you also receive a lump sum grant to assist you in the costs associated with the arrival of the child, a maternity grant. If you get injured on the job, if you fall sick on the job for the 30 years that you're working, every time that happens, you have access to benefit. If you become too sick to work before you become pensionable, you have access to a benefit that will be paid to you for as long as you remain in that condition. When you become pensionable, you are entitled to your age pension for the remainder of your life until you die. When you die, we assist in burying you, and if you leave dependents behind, they have access to benefit. So it is for us to understand that this is a system that provides us with income protection throughout our lifetime, but especially when we get to retirement down the road. If God blesses us with long life, once we will have made the number of contributions necessary for us to qualify, we have access to that pension for as long as we live. And invariably, therefore, people end up getting out of the system more than they actually put in, because by the mere percentages that we collect from you while you're working and the percentage that we pay to you when you benefit, there's no comparison. At the moment, we collect, let's say, 13.75% of people's salary as a contribution on a monthly basis. When you are sick, when you're in maternity leave, or if you're getting an injury on the job, we pay you 60% of your salary for the month. Let's say, for all intents and purposes, you're sick for an entire month. We will pay you 60% of your salary, whereas you give us 13.75% of your salary. When you get to pensionable age, the percentage you qualify for ranges from 30% at the minimum to up to 60% at the maximum. The percentage that you qualify for as your pension being dependent on the length of time over which you would have contributed, or put another way, the number of contributions you would have made cumulatively over your working life. The longer you contribute for, the higher the percentage of your earnings you would receive as your pension. So the full value of your benefit is relative to a lot of things. And if you, let's say, you probably work for 30 years and never got sick, you never had a child, you would not have seen the value of Social Security because you had not had reason to access those benefits.
I see.
But certainly, those benefits are available to you upon the occurrence of specific events that affect your earning ability.
So it's like an insurance?
It is, yes, it is. It is. In fact, it is. It is national insurance or social insurance.
Social insurance.
Yes.
All right. So in addition to Social Security, Brenton, insurance products can assist us in planning for retirement.
Indeed.
What are some of the products that are available, and how can one qualify for that?
First thing I would want to say is I definitely endorse the need to at least have Social Security in place before going outside. Social Security in itself is the foundation to your house. We all know that a house has a foundation laid down first, and then you put everything else to make it more secure, make it look better. And the program is a very good program. But in itself, for the lifestyle that we want to live, it would not be enough. And researchers have said that for us to be comfortable at retirement, we should be making about 80% of our pre-retirement income.
Right.
And you heard that most Social Security is going to give you is 60%, up to 60%. So even if you're at that maximum, you definitely still need to consider, where do I find the 20% difference to maintain my standard of living? And We often believe that when we reach to retirement, things in terms of expenses are going to be reduced. No.
Not at all.
When you retire, 60 is the new 40. When you retire, you still want to go out. When you have friends coming over that you haven't seen in a long time, you still want to give them a glass of wine. You still want to treat them to some meals. So the expenses don't change. You still have to pay your light, your water. Everything is still there.
Not to mention
So
inflation.
that mindset or the myth that our expenses are going to reduce at retirement is no longer like that. It's never like that. So you definitely need to start considering, how do I address the gap? And insurance can assist with that. Insurance is not just about death. A lot of people think that. But we do have plans that actually can assist one when they reach a stage in life. It can be done for two forms. One is what we call an endowment plan. And what that basically is you take the plan and then you agree for us to give you a lump sum of money at some point in the future, at a particular age or after a certain number of years. You can choose whether you want to get it at 65, at 60, at 70. That's really up to the individual. And then there are other plans. We have one where it's more of an annuity system, and that's a very big thing in the United States. We haven't caught on to it in the Caribbean as yet. But it operates similar like Social Security, where you can choose to receive a not a lump sum, monthly income for as long as you live. But from my experience in the Caribbean, we prefer to get all of our money one time and take control over that. So there are options that you can look at to supplement and complement having Social Security. In order for you to get it, you just have to come into our office, have a conversation with us, and once we understand your needs, we can do the paperwork. Depending on the product that you choose, we may ask you medical questions to make sure that your health is okay enough for you to get the product.
Okay.
But it all starts at a conversation.
No, thank you for sharing that. Mr. Ettienne, for entrepreneurs, because we're also speaking to entrepreneurs, how important it is for them to make Social Security contributions?
Okay, it is important because, like everyone else, when you are healthy, when you are young, you are strong, you are able to work and earn. And because life is so uncertain, no one knows exactly what awaits them around the bend. So the payment of Social Security contributions by entrepreneurs, self-employed persons, is as important as the contributions that employees have employers pay on their behalf. Because these self-employed persons may find themselves in a situation where one day they may not be able to ply their trade and earn their income anymore. What becomes of them? But even more importantly, what becomes of the people that depend on them, their loved ones. So you pay Social Security contributions, not so much for your loved ones, but for you. But if, God forbid, in the event that something were to happen to you, the people that you leave behind can have something to fall back on from Social Security. But they also have a responsibility, if they engage people to work for them, to register and pay contributions on behalf of the persons that work for them. Now, a lot of them actually make the contributions because, as far as they're concerned, under the law, they must do so. But it is also mandatory for them to pay contributions for themselves. Because you will have needs like the employees have needs. And you may be able to save, yes, and as Brenton said just now, it is important for you to save, take insurance policies, and have other investments, because although Social Security guarantees you up to 60% of your income, you're going to need to supplement that with something else or some other things.
Certainly.
And he said Social Security's foundation, we see ourselves as the main pillar. And it is, it is for most people. And we have to be honest with ourselves. Our situation is such that even if we want to make alternative investments, save, sometimes we cannot afford to. We go from hand to mouth. But those of us who participate in Social Security, at least we have that basic level of social protection, or that basic safety net that Social Security affords to everyone who participates in the system. Now, those who choose not to participate or were not fortunate to participate because they never worked, then you cannot take care of them. But once you participate in the program, without fail, as a matter of course, you have access to those benefits. So it is pretty important for everybody without fail. Once you are working for pay and you are of age, once you are above 16 and under 65, you really should be paying Social Security.
Okay, okay, that's important to know. I've been hearing a lot about bridge pension. For those approaching retirement age, what is bridge pension and how can they benefit from it?
Okay. bridge pension really is something that government has put in place to tie public officers over between the time they retire from the public service and the time they become entitled to their Social Security pension. Since Social Security was established 46 years ago, in 1976, the age at which people accessed an age pension from Social Security had been 60. But because things have been changing over the years, or people are aging better now. And when you asked the question earlier, I wish I'd got an opportunity to comment on that, that the 40, that 60 is not 40. Some people say, you know, it's because of people like you. Look at how long you're looking at 16. That is why the increase in the pensionable age. And that is a fact. Because every 3 years, the Social Security system has to undergo an actuarial assessment to ensure that the system can be sustainable for the next 60 horizon. And when they come, they check the statistics with Social Security, they check the population dynamics, the demographics, everything. And they make recommendations and projections that are meant to propel the system forward for another 60 years. And they've been finding that people are living longer. Now, that I'm always challenged when I say that. And you made the point about the number of our young people who are dying. All of that is true. But the flip side of the coin is we have a number of persons, when they make it to retirement, they live long.
Certainly.
We paid pension to Mr. Heskif Kazim, the late master of the government Glovers Band, music lover, and he died at 104, something like that. Wow. So from 60 years to 104 years, we've been paying him for 44 years. Social Security is 46 years old. He could not have contributed long to Social Security before he became 60. But because the program had made provisions to give people like him what you call transitional credits, because he was about 50 at the time it started, so that when they got to 60, they could access a pension. Wow. Now, when they qualify at 60, at 65, you have to pay them for the rest of their lives, however long they live. And we boast about our longevity in Dominica. We have the highest number of centenarians per capita in Dominica. If these people had all contributed to Social Security, it means we would have had to pay them for more than half their lives. But that is the way the system works. Now, while we do that for some of these people, there are some of us who may not make it to 65. But again, I say to people, if you do not live to 65, you won't be there to need Social Security. You won't be there to miss Social Security. But what happens if you are there and you did not pay Social Security?
The big what if.
What if? So it is better you make the provisions and probably do not live to enjoy it. But again, if you do not live to enjoy it, but you leave dependents who can access it, you're better off making the provisions than not making it at all. So the bridge pension, I need to explain, is that government, once the Social Security pensionable age increased from 60 to 65, and government requires the public officers to retire at 60, they did not want them to settle for a reduced pension from Social Security. So they paid him a bridge pension between 60 and 65, so that when they reach 65, they can access their full pension from Social Security. Because if they come to Social Security prior to 65, they're going to receive a reduced pension for the rest of their lives. But I'm not sure if anybody else who have instituted that, but government has certainly done that as a way of protecting their workers from settling for a reduced pension from Social Security for the rest of their lives.
Okay, notice. We are speaking about building generational wealth and retirement planning, and we've spoken about the inevitable a few times, you know, what if you live long, what if you die young? And there's a taboo surrounding will creation. Many times when this topic comes up, people immediately think will and death. In your practice, Mrs. Didi, what are some of the negative effects that you've seen for people who failed to plan or failed to prepare a will, failed to conduct estate planning?
Yes. Lawyers typically wear black, huh? But whenever I'm invited to speak about wills, I wear bright color. Because I don't like people thinking about, you don't have to think about death as if it's something that, you know, oh my goodness, it is a scary thing, but it is a fact of life.
Yeah.
It is a fact of life. Every one of us must die at some point in time. And the important thing is that we prepare for that. Right. And once you prepare for that, you can rest easy. You can go about your business knowing that things are in place. People come sometimes and they say, boy, if I do my will today, I might die tomorrow. So I'm not doing it. I've never seen that. I have never seen that happen. I mean, I've done tons of wills throughout my career, and I have never seen that happen, that they do a will today and then soon after they pass away. Except sometimes you do meet people on their deathbed wanting to do a will.
Yes.
And in those circumstances, of course, they would die soon after. But not doing that will is more disadvantageous to you. Okay, so in my career, I have seen litigation happen. By litigation, I mean people going to court. People go to court to fight over mommy and daddy's estates. When they die, most of the times it's because mommy or daddy didn't leave a will. Most of the time, that is why. Sometimes you do find that people challenge wills, and that will go to court, of course. But by far and large, it is when there is no will, there's no direction as to who the property is to go to. Sometimes the property just stays and languishes. It just stays there and nothing happens to it because, one, nobody steps forward, or two, the person that steps forward is the most irresponsible one of the children, and that's the person who steps forward and they don't do a good job, and you find and the property just stays languishing because a will was not made by the person to name an executor, meaning the person who is going to be in charge of your affairs, in charge of distributing the property. They didn't name an executor, and they didn't say how they wanted their property to be divided. So you find not having the will now, people are fighting over the property, and people are wasting it, and that's how it goes. So that is definitely a disadvantage of not having a will.
But what if at present you and your siblings have the best of relationships, and your parents believe that I don't need to do a will because you will take care of everything? What advice would you give them?
That's when the problems arise. It is always the people with the best of relationships when it comes to property and money. That is when you see the bad side comes out in everyone, and everybody starts to fight over it. Unfortunately, people have the best of intentions, sometimes. You will find sometimes that each sibling has the best of intentions, but what I want is different from what you want. What I think is best is different from what you think is best. So the best way to avoid that and to avoid that conflict is for the property owner to just make that will and say what should happen. Simple as that.
So in that case, can you walk us through the process of creating a will? Must I go to a lawyer? What is required? Must it be registered? Should it be witnessed? Can you walk us through that?
Sure, I can. I'm a lawyer, so I always say anything to do with the law and anything to do with legal documents. It's always good to get legal advice. But unfortunately for some people, either that's not an option because they don't have hundreds of dollars to spend on a lawyer. For some people, just the thought of going to a lawyer alone is like, it's very ominous. They just don't want to do it, and sitting in that lawyer's office, they don't want to do it, So, I mean, it's unfortunate, but, that's the way it is. So you don't absolutely need a lawyer to do your will. A will is one of the oldest legal documents ever, and lawyers basically use the same language. It might be different for some people for several years. So you can actually do your will yourself. In the pre-internet days, you would have will forms sold in stationery shops. So you could actually go into a stationery shop and buy a will form and fill it out, and then you have your will. But in the internet days, of course, in most countries around the world, you find that you can go online and just do your will. So what is required basically is you name an executor, meaning the person who you want to be in charge of your affairs after you are dead, and that person will be responsible for sharing all of your property according to what you have written in your will. So after naming the executor, you say what you want. You say who you want your property to go to. I leave my house located in Goodwill to my daughter Jan. I leave all the money in my bank account at National Bank to my son Jerry, and so on. And you go forth like that. And at the very end, you ensure that when you are signing it, you have two independent witnesses with you. Right? By independent, I simply mean somebody who's not getting anything under the will. Okay, that's important. And it's important not because it will invalidate your will, but it will invalidate any gift that you left for them. So if I leave a gift for my daughter Jan, and my daughter Jan is a witness to the will, she doesn't get that gift. Everybody else will get theirs, but she won't get her gift, unfortunately. So you get two witnesses who are not getting anything under the will. They are adults, and you ensure that you sign your will in front of those two witnesses, and those two witnesses will also sign your will saying that they saw you signing your will. So everybody signs in each other's presence. make sure the will is dated, and you have your will, it's done. It's
So,
done.
in
Yeah.
terms of the executor, that person has to be independent, or it could be a family member
can
or
be.
somebody that is benefiting from that will.
It can be a family member, somebody who is benefiting. A lot of times it's actually advantageous to do that because the person has a vested interest in wanting to see the
Okay.
thing done. But you have to be sure it is somebody who is responsible, somebody you trust to do what is right and to handle affairs. The person, of course, has to be an adult of sound mind, and that's it.
Well,
And tell them that you're making them their executor.
But I must ask, you've already shared that it is not as difficult to create a will, but is it expensive? I know recently you would have launched your platform, Caribbean Wills.
Yes.
Can you tell us a little bit more about that and how we can use your platform to create wills at a cost-efficient price?
Well, what I can say is that I developed the platform simply because, again, throughout my career, I saw the difficulties with people not having wills and the siblings fighting, the properties going to waste and so on. And I said, what happens out, what's going on in the rest of the world? And you find that in the States, in England, everywhere, they have online platforms where persons can go on and do their wills themselves. But those online platforms, of course, are generated by lawyers. They are created by lawyers so that you know what you are doing is something that makes sense. You know that when you go into the program, you put in your information, you know that what you get at the end of the day is something that makes sense. They're developed by lawyers. So in the same vein, I and a few others, we came together, we said, let's put together this online platform for the Caribbean, for the Commonwealth Caribbean. We all do our wills the same way. So let's create this online platform where anyone who doesn't have the hundreds of dollars to go to a lawyer, lawyers charge a few $100s. I mean, you'll find different prices depending on which lawyer you go to and depending on the complexity of your will as well. But persons don't have those few $100s, or if they have it, it's just not a priority to spend that amount. So you could go online, it only costs $39.99 US, that's about 120 EC dollars, and that's it, and you get your will done yourself. You fill in the information, out comes your will at the end of it, and you sign it before 2 witnesses, as I said before. Put your will in a safe place, inform your executor, and there you have it, and it is done.
I'm ready to write my will.
I can say that, I designed it because, like I said, there are some people out there who cannot afford, or it's not a priority in terms of their money, but they want to do it. And also people sometimes just don't want to go to lawyers. I don't know why, we're nice people. And also because some people just have a very simple will to make. You don't have a lot of things. You don't have any complex anything to do to create a trust or anything like that. You just have your house, or you have your car, or you have your family heirloom or your PlayStation, and you want to leave it to someone. You can go on and just do it, and you get it done within half an hour, and it's done. Now, if you have a vast amount of property, or you have some kind of complex thing in your mind that you want to do. You want to create a trust so your child cannot touch it until they're 30 years old, and be sure that they're married before they touch it. Go to a lawyer, Go to a lawyer and sit with them and discuss all of these options and let them do it. The online platform is a do-it-yourself. It's for simple wills, for people who have, basic wills and so on, and who do not have that kind of complexity to deal with.
This has been certainly enlightening. Like I said, I'm ready to write my will, to leave my pences, whatever I have.
Whatever you have.
Brenton, would you agree with me when I say that it's never too early to start planning for retirement?
Definitely.
So where should we start?
The financial gurus who speak about it say that you should start from your first paycheck.
From your first paycheck?
From your very first paycheck, you should be taking out some money to put in a retirement fund. Not a savings, a retirement fund. And there are 2 aspects to saving. You have your short-term and medium-term goals. Those are things you put money in for whether or not you have an emergency in the near future. But then that should never mix with funds allocated to when you reach retirement. And we often overlook that. Sometimes we say, okay, I have a savings, and we think of it long-term, but the actual action involved with that savings is short-term. So yes, I have a savings, and that's for when I reach retirement, but then something comes up, You go into it and you tell yourself, don't worry, I'll put that back next month. Next month comes, you have already forgotten that you took money out. Something up comes again, you go back in it. So you really need to look for a tool that is sort of going to discourage you from dipping into that. That's why Social Security is effective. You're forced to contribute and you cannot withdraw. So it's really meant for the long term, and in a similar fashion, our retirement products at Sagicor are geared towards a form of long-term nature to force you. But I also want to touch on another point of retirement planning, and it comes from Ettienne's point earlier when he was speaking about young persons and entrepreneurs in case something happens. There's one thing that we often forget about when we think about retirement. It's one thing to save. The question is, how do we protect what we have saved? You see, in life, you can have built up a nice savings. If you're an entrepreneur, your business could be booming and you could have money piling up there, money you can bathe in. But when life knocks on the door, if you have a major medical situation, one incident can wipe that entire savings in one go. And I like America for that. America is very big on data. And in Barack Obama's State of the Union address, I think that was in 2009, he spoke about the high level of bankruptcies in America. And the number one contributor to bankruptcies up there was medical expenses. That shows how significant it is, because you could have saved for your entire life, reach 65 and figure that I'm okay, I have a nice account there, I have $1 million, I'm just calling out numbers. But then at 66, when you have just begun, you get a brain tumor. A brain tumor can cost as much as $900,000 to handle in the United States. So in 1 year, your savings for your retirement is gone. And after you recover from it, yes, you've recovered, where is the money coming from? So as much as we are encouraging persons to, yes, put some money aside for savings, you also have to consider, how am I going to protect that? And health insurance is definitely important from that aspect, protecting the money that you have put aside. Let the insurance company deal with those medical emergencies. Don't use your savings for that, your retirement savings for that.
That's interesting. Do we have any questions from the audience as yet?
Somebody wanted to know whether they can name a beneficiary for Social Security.
Can you name a beneficiary for Social Security?
No, you can't, because the law identifies who your eligible dependents would be. First and foremost, your spouse and or children, dependent children who are under the age of 21, unemployed, unmarried, and at school. Or if you have an invalid child, a child who is, let's say, physically or mentally challenged, never went to school, have no earning ability, irrespective of the child's age at the time of the parent's death, that child will be eligible. And in the absence of a spouse, and when I speak of spouse, we recognize common law unions as well, whether you're legally married or not. But if you've been living together in a house as man and wife for at least 3 years, the surviving person can be eligible for receipt of survivor's benefit. Okay? So our laws reflect our reality on the ground. It's not that we discourage people from getting married, but the reality is that a lot of our people live like that without being legally married.
Yes. It's unfortunate that our intestacy laws do not follow that, meaning the laws that apply when you don't leave a will, that they do not follow the common law, they don't recognize a common law spouse at all. That's very unfortunate. I mean, that's one thing, it would be good for us to advocate our lawmakers to change, because that is our reality. Many people live in a common law situation. I mean, you die without making a will, so you have not provided for that person, and they're left with nothing. As we would say in Dominica, they're left crying and out. So that's,
I wanted to make one additional point on that. Well, you are not able to name a beneficiary. The law makes one exception, that you can have a situation where you have a legally married couple, and for whatever reason, they are separated, and one of the partners, one of the couple, is living together with somebody else. That person can nominate that person that they live with as their beneficiary for purposes of accessing survivors' benefit upon their death.
Oh,
And if they make that nomination, we have to honor their
right.
request and allow that person to access that benefit upon their death. But if they do not make that nomination, even if that person is the one who was there doing all the dirty work, taking care of you when you could no longer take care of yourself, and the legally married partner comes up, once there is no evidence of divorce, that legally married person still have
Gets
access
the
to the
benefits.
benefits.
So what's the process of nomination?
So you just write a letter saying, I am so and so. I am writing to say that upon my death, I would want this person to access my benefit as opposed to my legal wife getting the benefit. And if you write to that effect, we have to honor it. We would
As
not-
simple as
as
that.
simple
Wow.
as that. But if you fail to do that, no, if you fail to do that and you pass and the person who is living with you comes forward and make a claim, until we have evidence to the contrary, we will probably make the claim once we are satisfied. When somebody in the community says, I have known them to be living together for the last 30 years, at Justice of the Peace and Notary Public, somebody, of certain level of thing in the community says, I know them, and not so much that I was told that they've been living together. I know from a position of knowledge because I've been living there. If we get that evidence, we will proceed to pay. But after starting to pay that person, the legally married partner comes forward, present the marriage certificate, and we do research, and there is no evidence of divorce in the courts, in the registry. Then we have to suspend the payment to that person.
Oh my.
Yeah. And sometimes have to recover the benefit.
Oh my.
Because any benefit that is erroneously paid has to be paid back to the system.
Has to be refunded.
Yes.
Oh,
And
wow.
if you cannot do it from whatever, we have to deduct it from a future benefit that's payable to you.
You what?
Yeah. Because the system is going to give you benefit, yes, but not at all costs.
Yeah.
There are certain conditions that have to be satisfied.
Right.
Yes.
And if those conditions are not satisfied, then you cannot access those benefits.
Thank you for that information. Duly noticed.
Somebody wanted to know the letter, the overseas and notarized letter we do.
Anything originating from overseas has to be notarized, yes. Yes.
We also have a second question. What is the probate process re a will?
Okay, so as I said, the will, drafting of your will is straightforward, right? So that you prepare your will, it's done, you've signed it in front of the two witnesses also sign, you have a valid will there. Once you don't need to register it anywhere. So people talk about registering their will in the Caribbean. You don't need to register that will anywhere during your lifetime. So you don't have to bring it to the registry and say, please register my will during your lifetime. It is only after you have died, that is when the probate comes in. And probate essentially is your executor taking your will, going to the registry and saying, look, this is the will of the person. I would like it to be probated, or as we say, registered. I would like it to be proved that, yes, this is a valid will, and the registry gives you a nice document with a big red seal on it saying that it is a valid will and you are in charge of the person's estate. They give you a grant of probate. That is what it is. It comes into effect after you have passed away. And typically, to get that probate, typically if there's a will or even if there's no will, you still have to go through the process. Anyway, it's not called probate, it's called letters of administration, but you do have to go through the process to get that document with the red seal from the registry on it to say that you are in charge of the person's affairs. Typically, you would go to a lawyer for that. If it's a very small estate, you can go directly to the registry.
Okay, so we are winding down our time. We have one more question from the audience. What advice would you give a jackpot winner when it comes to estate planning and building generational wealth? I'll start with Brenton.
I'm trying to picture myself in that situation.
To you all.
There are a lot of different things that I would do. First of all, I would first assess what I have in place at first. And it goes back to Social Security. Can you do some prediction to forecast what your benefit is going to be in the future? After going through that exercise, if you realize that Social Security is only going to give you 40%, then immediately you know that you have a gap of 40% to fill. So to fill that gap, how can I use some of the proceeds of that jackpot to ensure that when I reach a stage that I'm okay? The other thing is, if I don't have health insurance, then paying health insurance in advance if it's possible. Because at the same time, you have to protect your wealth. You could get a jackpot today and then tomorrow God decides to knock on the door and that's gone in a split second. The other thing is, rather than just leaving it in a bank account to pay to your family, some of that could also go to insurance. Because if you're taking a fraction of this, a monthly premium, to pay for your health insurance, and you passed away within a year, 2 years, 3 years, 4 years, how many years, all you would have spent is just a fraction of that to get an even bigger payout than the jackpot itself. Then, if you're adventurous, some people might say go into crypto, but that's a whole different conversation. But the whole point is, don't just let the money sit there, don't just spend it, but be a bit strategic. Assess where you are, assess where you need to be, and see how that money can get you to that position.
Yes, you make a fair point, because research says that jackpot winners tend to go bankrupt within 5 years of winning their earnings. What do you think, Mrs. Ettienne?
In terms of investing that money and so on, it's not my area of speciality, but I mean, the experience I have is that, look, you put it in a bank, you get less than 2% in the bank right now on that money. So, you know, and at the same time, you have a mortgage on which you're paying 5% interest. Guess what you should do with that money? You need to get rid of that mortgage, right? Pay off that large debt that you're paying that higher percentage of interest on. And of course, you invest it. You invest that money, whether it be in insurance, on the stock market, by government bonds, whatever it is, you invest that money. And as soon as you get it, the day you get that check, well, it should have been in place even before, but as soon as you get that check, you make sure you do your will and you ensure that that money is going to be protected, even if you close your eyes tomorrow.
Certainly. As a final piece of advice, because we've come to the end of our discussion, what tips can you share with individuals who are 20, 30, 40, 50, 60, or approaching retirement age, or in an effort to prepare for the inevitable, because we just never know? Mr. Ettienne, what advice would you share with our listeners as we close?
Okay, to as Brenton said earlier, to begin thinking of retirement, begin thinking of the end from very early. The end will come. We just do not know when.
All right.
We do not know when. The unfortunate circumstances will come, because once we're alive, we're exposed to certain risks. We're hoping that it never happens, but they inevitably do happen. I think I would like to say to people, better you see, an ounce of prevention is better than a pound of cure. So do what you have to do. Do what you are able to in terms of preparing for retirement, for death, and hope that it doesn't come. You are going to be better off at the end of the day having done this than not having made the preparations. Better to plan than not to plan.
Yes.
But if you fail to plan, you're planning to fail.
Indeed.
All right.
Now, Mrs. Didier?
Yes, I would say to persons, I mean, no matter what age you are, really, that's it. You have to prepare. You have to think of, when I get to that age where I either have to retire or want to retire,
Yes.
am I prepared? Do I have everything in place for that? In some countries, they tell you that you need to do 3 things: your will, a durable power of attorney, and a living will. We don't have the last 2 in Dominica, unfortunately. A living will is that if you're on your dying bed in the hospital, that living will would say what you want to happen to you. You know, even if you're not mentally well, but somebody has your living will, they will say, this is what the person's wishes are until they die. We don't have those things in Dominica. But those 3 things typically go together in estate planning. But not having that, at least in the very least, do what you can do. Do what you know is available to you to protect your wealth going forward from one generation to the next. You do your will, you have your investments in place, whether it is insurance or otherwise, you have your savings, you abide by the law and pay your Social Security, and you know that everything will be okay. Then you can rest easy.
Thank you for sharing that. And finally, Brenton, your final words of advice.
Regardless of your age, you need to have a conversation about your goals in life. Now, with everything that we've spoken about, it comes at a cost. We know that. We don't have to hide about it. But the way you have to approach life is that you have to understand, though you may have a long list of things that you want to do, yes, you recognize you cannot do everything right now, but you identify the priority areas. A good place to start is where or on what that is the most important to you at this point in time. And life is a journey. I can use myself as an example. At the age of 24, I got my first life insurance policy. Did I need life insurance at that age? Not necessarily, but I figured, hey, if I had to die early, I wouldn't want my family to be in some sort of debt to bury me. So it was just a basic plan. Then come 28, I got my daughter, my princess. The first policy I had was not enough. So I had to get a second policy because we were thinking about generational wealth. So I've been thinking about that since I've been young, and I've always had the motto, if I die today, she does not have to depend on any man.
How many policies do you have?
So fast forward, at present, I have about 9 different policies.
Wow.
Yes, so it has been a gradual process. As I've been getting older, understanding life, I've been seeing where the risks are in my life, and I choose to transfer those risks to a company. So I have life coverage, I have income protection, I have retirement plans, the list can go on. But it started from somewhere. The whole point is, even if you're young, start making plans for the future, because as we heard earlier when we started off, young people are dying. It's more public right now because of social media. So we are no longer super people like we used to think. We fall sick too. Things happen to us. We find ourselves in financial situations. So we cannot see the signs around us and choose to ignore it. It's like driving a car and you see a pothole and you choose to go in the pothole. And then you complain after, my tire burst. We see the potholes in life. So we have to start swerving and start maybe seeing what we need to do to prepare for it. But it all starts with a conversation. Whether you're young, whether you're in your 30s, 40s, 50s, once you see there is a risk in your life, have a conversation, whether it is with the lawyer to put your will in place, Social Security if you have not started, or the insurance company to see where we can take up some of your risk for you.
And of course, they can come to Finance Focus to help them manage that money.
Correct.
Thank you so much, panelists, for joining us this evening. Thank you to our listeners on all the different platforms. This brings us to the end of our live studio discussion for Financial Information Month. But this is not the end of our celebrations for this month. This Saturday, we will be hosting a live app festival. This is what Sherma calls it, a financial app festival. It will be held at the parking lot of LA Jupini, near Fresh Market, and you can come on down to receive assistance with signing up online to the online platforms for the different financial institutions, especially for the senior citizens who would need that type of convenience now. If they cannot make it to the bank, you are going to get live, easy, convenient assistance to help you set up online. There will also be different booths from the different financial institutions who speak on different products that they're offering. We will have health checks from some of our nurses. So we invite you to come on down from 9 o'clock on Saturday at the Jupini's parking lot near Fresh Market for our first ever Financial App Festival. Once again, thank you to our listeners, thank you to our panelists, thank you to our FIM partners as we continue to celebrate Financial Information Month under the theme Financial Advancement through Enlightenment, Partnership, and Balance. Have a good night.
Thank you.
Thank you.